Hi folks, Rick Berube here, live from Success Series. Today we are very fortunate to have a wonderful interview. Oh, look at that, there he is. John Ingram from Axia Mortgage. Watch this, kaboom. Almost like I knew what I was doing. Nope, didn't work.
For those of you that don't know me, I'm John Ingram from Axia Home Loans. I have actually been linked to the Berkshire Hathaway relationship for 18 years of mortgage through various roles. I'm currently one of the managers out of the Nevada office for the company. Obviously, we're servicing all three marketplaces, and our company is actually the only fully employee-owned mortgage company in the United States. We're kind of proud of that, obviously. It really keeps us focused on trying to do something good for our customers, good for our employees, and good for the community. And it's something I'm really proud of. Is it shows through the decisions that we're making as we're going through this craziness. The decisions that we're making really are focused on how do we best serve our community, how do we do good by them ultimately, and good by our company for its long-term health. So it's a nice place to come from. You can speak from confidence in a lot of things. So
Gives you pride of ownership.
Yeah, I'm proud of this.
Love
company.
it.
I'm proud of this company. Everybody, honestly, everybody that works here is ultimately selected in a way, insofar as you are never embarrassed by the person you're working next to, right? You can be proud of them and know that they are not going to do something to hurt our own joint reputation, and that's something I really like. It's not been the case at every company I've worked for where, if you can close a loan, if you can do that, we want you. That's not our standard. You have to treat your coworkers well, you have to treat your clients well, you have to do ethical business, that sort of thing, in order to work for us, and I'm proud of that for sure.
That's great. And I can testimony, I've used them at least 5 times since I've been here, and my friends, and every one of them's gone great.
Sure. So that's who Axia is. We service, I would say, 18 states at this point. We're mainly West Coast focused. We have other areas of the country taken care of, but I think if you can connect with an Axia loan officer in your marketplace, somebody that you kind of communicates in a way and you connect with, you won't be disappointed with what they offer and who they are, I think.
Okay, cool. So how long? So a little bit about yourself. You've been doing this for a while yourself, haven't you?
Yeah, I'm approaching 20 years, almost my entire career with the Berkshire Hathaway relationship, and have had various roles, whether it be operational, where really one of the foundations to my success, just if I'm speaking about myself, is I'm a little bit of a technician when it comes to loans. I like to understand the mechanics of why things, we say yes or no to things, and truly have that as a foundation of a sort of expertise. That's what I end up selling. I may not be the best salesperson out there, but I am an expert. When you come to me, I can give you the right answer and generally the why of something happening, which is really important to be able to anticipate what is the solution to a problem, right? So very much in our business, there's a rule for everything.
Yeah.
Every situation has a rule, and to understand the why of it lets you figure out what that solution can be. What's the workaround? What's the fix? Because we're in a business of working with human beings that every single one is different. Every single loan is different in some way than a previous loan, very much like a fingerprint or all those cliches. And so having that sort of skill set has been what I've ridden my entire career, and something I'm truly grateful for is that I've been able to touch so many loans early on in my career, build that foundation, and then take it forward in time. Now, our business continues to evolve as situations evolve in the world, and so there's always something new, there's something unforeseen, and we have to work our way through.
Absolutely. Okay, cool. So take us through the process. I'm going to get into times now, but
okay.
Take us through the process of, if how you would work with a buyer today prior to COVID-19, pre-qualifications, what you would do before you went out, all that kind of stuff.
Sure.
Remember, you're talking to real estate agents.
Right. I mean, the process and the options that are out there still really do walk through the same sort of steps at the end of the day. You have your pre-qualifications, verbal conversation with the consumer, looking at their credit report, trying to get a feel from them via just verbal talking or possibly in a Zoom meeting, trying to find where are the hidden areas that they're not thinking of telling you, where maybe they're not telling you the whole story. Reading between the lines is critical when talking with consumers ultimately, because you'll be able to dig out where the problems might be. It's interesting, or it's funny how when I talk to a consumer, they might answer a question, how much money do you make? Oh, I make about $80,000. All right, great. And then you have to start peeling back on that. Did you make $80,000 this year? No, well, I just got this big bonus that's going to be coming, and it's going to make my income $80,000. And you just peel back layer upon layer to try to understand what is the real truth. And so there are situations where pre-qualification can be reliable and a great starting point for working with the consumer, and then there are situations where it's never okay. Anybody who's self-employed should never be pre-qualified. They should only be pre-approved, because the language they speak is different than what the mortgage actually speaks. When a self-employed person tells you how much income they make, it's never what the mortgage uses.
Right.
And it's never accurate. It's never going to be what you can actually use. So it's worthless to have you tell me. I really have to see your documentation. I need to see that tax return to show it, and so on. So there are situations where it works and it doesn't. But I will tell you, it hinges upon really the skill level of that particular lender. And I'll give you an example. A consumer who goes through a bankruptcy will tell you that they've had a bankruptcy. What they won't tell you is that inside that bankruptcy they had a house and they gave that house up to foreclosure. Their attorney only ever uses the word bankruptcy with them. So that's all they think they have. They didn't think that they also had a foreclosure, which the mortgage says, yes, you had a foreclosure because it was inside that bankruptcy. And the credit report doesn't tell that story, right, because all it says is bankruptcy too.
Right.
And so it's reading and getting underneath those stories. It will rely on the skill level of the lender you use. So in general, we don't want to use pre-qualifications very often without having our eyes open and being prepared for what that means. Separate from that, pre-approval, great. We're still looking at documentation. Now, this is where things start getting a little more interesting. Modern consumers today don't have fax machines. And we don't want them dropping off paperwork, right?
Right.
We've closed our office to the public. We have people that are still there, but we don't want the public coming in. Mail takes too long. We want to move rapidly. So in our world, we have a phone app that allows a consumer to take a picture with their phone and get us documents that way. And it uploads the document straight into their loan file with us. It lets them edit the document and get all the edges and make sure it's clear and do all those type of things to where we get a good quality submission and we're getting documentation from them. This is the kind of solution you need in today's market, with everything sort of happening virtually or just over the phone. Obviously, we have web applications that give the consumer basic needs list and allow them to upload documents from their computers. We're there on the phone and we're there on apps. So we're in all the major areas. As far as communication with consumers, you have email, virtual meetings like this, or phone. That's all happening and as necessary. The one good thing that I can see coming out of this is if we can get more consumers comfortable with using technology, they're going to have a better experience as they go forward into the future. Because a little practice with using a Zoom meeting and getting into that is going to make it much easier for me to see your computer screen while you want to show me something you have a question about. Instead of you saying, well, it's on that piece of paper with this on it, and I don't know what page it is, you can just hammer it through and say, okay, show me the document on your screen, and we'll talk about it. So in that way, we have the technology already in place. It's just a matter of enhancing its usage and going forward with that.
Okay, cool. So that would be the process, and obviously that gives your strength way better when you're making an offer on a property. You have all that ahead of time, verified. So you're saying the best way to do it today is to, in most cases, get pre-approved before you get.
For sure. Yeah. I mean, it's really where the same world we've been in for the last 7, 8, 10 years at this point is if your client is not getting pre-approved, they're taking very large risk, and they're taking very large risk with their money and your time,
right,
and your money. And so we want to be really, really selective about that. As human beings, I totally get it where I have a realtor saying, John, I'm supposed to show this person a house tomorrow. They don't have a letter or pre-qualification. Can you talk to them real quick and see what you think? That sort of thing on a one-off, first time I want to show a house, I get it. But I wouldn't want to spend 2 months working with somebody who's just pre-qualified.
Right.
I want them pre-approved. They have to show. At the end of the day, if we can get them to put effort into their own qualification and effort into their transaction, they're more vested with us. They're more likely to say, okay, I'm sticking, and there's a couple things. I'm sticking with you, Rick, and I'm sticking with John to go forward because I've already done all the work with them. I've given them my documentation. They know about me, and I don't need to start from the beginning. It's nice to find out who that consumer is in the beginning as opposed to finding out that they're not that person later. The person who wants to say, no, I just want to get pre-qualified for now, just let me see what I've got. And then that's the same person that wants to go into contract and then shop for 3 different lenders and then blow through their contingency periods. And it's all your hassle to fix, all your hassle to clean up. And they have to sort of learn a lesson in order to kind of move past that. And so I'd rather than not learn that lesson, I'd like to learn who that consumer is sooner in the process than later. Make sense?
Absolutely.
Yeah.
Absolutely. So do you want to spend just a few minutes giving them the VA, FHA conventional differences?
Sure. In general terms, FHA, VA, government-backed mortgages, they are widely available. They have very sort of set rules. And conceptually, they're more flexible in regards to saying yes or no to a consumer. They're the ones that, for example, have this one-size-fits-all approach to saying yes or no. What I mean there is, on an FHA loan, if you're at a 640 credit score, you get to do the same 3.5% down payment as somebody with an 800 credit score. They're not asking you to do more because you're more
credit's
vulnerable
worse,
in certain areas, or you don't have as much savings, or your job, you have multiple job changes, these kind of things. Those programs are very much kind of designed to be that one-size-fits-all, treat everybody the same, level the playing field, right? The limitations with the programs, specifically FHA, is most commonly the maximum loan amount.
Right.
It has a lower limit in our market than for other loan types. Currently, FHA will let you do $345,000 on a single-family residence, condo, townhome, in the loan. So that puts your minimum down payment, maximum sales price at roughly $353. With minimum down, that'll get you into that $345 house. If you go above that, that's all extra down payment for you,
right.
And that number can get really big when you're talking about trying to buy a $400,000 house.
So that's really good if you want to buy a condo, but for being a single-family house, it could be limiting.
Yeah, you'll be limiting your price range for sure. So service is a great part, and that's on it. I guess I should say this. That is intentional by FHA and by HUD. They don't want to do every loan in the marketplace. They want to support the core beginning sort of 60% of the marketplace. And so they set that loan amount at that level intentionally. They actually got into a little problem where during the last crash, going back to 2008, FHA was doing like 70% of the loans out there. Way more than they wanted to do. And that was too big compared to what their mandate was. And so what they did is they started ratcheting up the cost of mortgage insurance on the FHA loan, making it less attractive compared to conventional loans that you could get. And therefore consumers were shifting over to conventional as being the better option. And they were shifting those loans out of their risk and onto Fannie Mae and Freddie Mac and so on. That's kind of mechanically where FHA is. I will throw out this idea right now in the marketplace. You're going to see very big disparity from one lender to another in regards to minimum standards for these loans. There's all kinds of choices being made from lender to lender in regards to what their risk tolerance is. And so you've seen most recently Chase. JP Morgan Chase came out and said, we're raising our standard to 700 credit score, 20% down minimum. And I know I've had a couple of people approach me and say, John, is that all loans now? Is that everybody? No, that was Chase making their decision. Wells Fargo raised their standard as well. I think they're up at like 680 right now. Axia, we put our limit at 640. There are lenders, just to be honest, there are some lenders out there who are still going lower, but the catch is what we call overlays did they put on top of it. We'll do a 600 loan, but you better have 6 months of house payment as savings that's going to be untouched. Or we don't allow cosigners or these type of things. You're going to have these little nuances out there right now. VA mortgages are awesome. Those haven't really moved around very much, but the key to things to understand about VA now is they took off the maximum sales price or loan limit on VA loans. You can now get $1 million VA loan if you wanted to with no down payment. That exists. It used to be limited to the maximum loan amount that was set by Fannie Mae and Freddie Mac, the conventional loan limit. So today that'd be $510,000. VA would max out at that. Well, they took that limit off. They raised the cost of their VA funding fee a little bit, let things go up, and created more flexibility there. Those loans are really, just my sort of feedback on this would be, they're the best low to no down payment loan you can get if you're eligible for it. Almost across the board, if you are eligible for a VA loan, that's the best product you can get, and you should use that. There's really not a reason to not.
I got a question.
Sure, Vito.
I just want to make sure I get this straight because I've got a couple of VA people. You know, a lot of the other
Someone's asking a question right now. We will repeat it.
Even though everyone else is tightened up, VA is still zero down. What
Yeah.
about credit score? Has that changed?
So, yeah, a great question. And I think
Repeat the question.
This is the right way to think about it. So the question was, can you still, is it true, you can still get VA loans with zero down, and can you still get them with, say, certain credit
Not
scores,
perfect
that sort of
credit,
thing, not perfect credit or whatever? And the answer is yes. And here's what I want to start with. None of the major rule makers, Fannie Mae, Freddie Mac, VA, FHA, none of them have changed a single rule so far. It's only lender by lender specifically tweaking their risk profile of borrowers. So if in this case, Chase, if they want to raise their criteria to get a VA loan to 700, they can do that if they want to. That's their choice. But the VA itself did not change that rule, and nor did Axia. So yes, Axia, we increased our preferred score to be 640 or higher on a VA loan. We still allow no down payment. All the other features are there. Would we consider doing somebody with a lower credit score? We would. Want to make a prudent choice about that. We have to look at that borrower, understand, are they in a strong situation or a weak situation, those type of things. So we can make a judgment call. None of the rules for the core loans have changed. It's just lenders tweaking their own risk profile. Does that make sense?
Awesome.
Yes, so even VA possibly, not with you guys, which is great to hear, but VA possibly, lender by lender may say, no, we don't want to do no money down and we want.
Yes, that's possible. So each individual lender, even on a VA loan, not just FHA, even on a VA loan, they can say, we want our minimum credit score to be 680,
right,
or we want at least a 5% down payment, or these type of things. They can make those decisions and apply that. And really one of the takeaways for agents that I would give you is this. It's absolutely, in this time today, it is critical to understand why a consumer is being told no to get some kind of financing. Because then you can check with us to tell you if that's an industry rule or that specific lender rule, right? We'll be that resource, that sounding board for you. That's part of the advantage of this relationship is that you can call me and say, hey John, this is happening on another deal with another lender. What do you think about that? And I can give you my 2 cents and let you kind of advise your consumer accordingly.
Yep.
Yeah.
All right, cool. All right, so thanks, Vito. So in today's world, with
Yes.
everything going on,
Yes.
first question is, have you seen a slowdown, and if so, about how much?
In purchase business, yes, we've seen a slowdown. I would say, we're anticipating, truthfully, purchase transactions to slow by about 40%.
Okay.
that's being more than made up for by refinance volume with lenders.
Yeah.
With interest rates being so attractive, those lenders that can handle volume, we can really improve the finances of a consumer significantly through a refinance, whether that's giving them some cash to have a safety net, giving them cash to go and buy an investment property and set up for that.
Somebody's getting attacked.
Somebody's being attacked by their dog. Sorry.
Oh, I'm so sorry.
We can hear you. That's good.
We needed the entertainment.
Yeah, thanks for that. I'm a dog person, so it's good. Where was I at? Jeez. So yeah, refinance volume is usually spiked, and it's interesting. One of the secrets or hidden things going on in the background is that lenders are actually moving their interest rates higher to slow down their volume. You're seeing this with some of the biggest sort of refinance lenders, the major banks, that sort of thing. They are actually pushing their interest rates higher than what they would normally be to slow down their volume, to get through the loans they have, and sort of manage their way
It's a
through
good
it.
problem to have.
Yeah, because you don't want to piss off excuse my language,
No problem.
make angry your loyal client by neglecting them for 2 months. I just had a customer talk to me about going to a bank, and it took them 6 months to refinance his house. 6 months! I'm like, what are you talking about 6 months? 30, 40 days at most. You should be done with that. That's purely, I'm completely overwhelmed with the amount of business we have as a company, and we'll get to you when we get to you. That sort of thing. And that's the nature of the beast right now.
And we have a question. Okay, so and there's 2 questions in there because I'm going to ask one too.
Okay.
I'm a tipped employee.
Yes.
Okay. How do you handle that?
So, yeah, you're a tipped employee, and you're not currently working.
Yeah, some of them. Well, okay, so that's the second part though. Let's say before crash, you're a tipped employee, and some of them show the tips right on there too. So explain that. Somebody asked that question.
So in normal world, let's say we're working on our job and I'm receiving tips like normal. A traditional mortgage, FHA, VA, conventional, they're all going to use whatever tips you claim on your taxes, W-2s, pay stubs, right? So if you show that you're making a certain amount of tips, I can use that amount of tips. And what they're going to do is they're going to take a 2-year average of those tips. So you have to have been receiving tips for 2 years. That's the approach they're going to use. Where we're at in weird times right now is those people, let's say that they're being paid by their employer.
Right, but they're not currently working.
They're not going to work. They're not actually getting tips right now. That technically should not be doable today. The lender should turn that away and say, I can't give you tips.
I have to wait until,
now. When you return to work, we can go back and start using those tips again. But this is the situation, in my opinion, the right answer for all those hotel employees that are still getting paid today, but are not actually going to work and that have only been told, yeah, we're gonna pay you through May 15th. You should not be closing those loans today because we don't know when they're gonna go back. We don't know if your income's going to return to normal. All those type of things. That does not meet the standard for getting a mortgage today. Unfortunately, they need to be paused until we get through this.
Right.
Does that make sense?
Yeah.
Good.
Okay, cool.
So, yeah, as we go forward, I do expect things to speed back up as we go back into the market. I think there are going to be people that take advantage of let's say the return of buyers in force to the marketplace. The early ones, maybe we start seeing negotiations that lean towards the favor of the buyer over the next 30 days, and you find sellers who are willing to compromise a little bit. It'll be interesting to see what happens. I'm in the camp, and as I've heard you and Mark say, I'm in the camp that I don't believe house prices are going to fall. We don't have enough inventory to really expect that, in my opinion. But if we did see suddenly we were at 6 months of inventory, could you see prices pressure down? Yeah, it's possible. I think you'd find sellers who ultimately then are having to compete for buyers instead of the other way around.
Okay, so somebody wanted clarification. So does that mean if I worked for a casino and I'm not currently working, but I'm still getting paid, do I go on pause or can I still buy?
You should go on pause.
Okay, that's what I thought. I wanted to make sure so they asked that specific question.
And that's good because this is something that ultimately that is really evolving sort of right now. I mean, in the last week to 10 days, lenders are shifting from okay, we'll close that, to no, we won't. And we should not, based upon the risk of the default, the forbearance on that mortgage, and that brings up a whole nother thing that's worth talking about ultimately, which is those consumers who close on a house and then immediately ask to skip their payment and say, I need forbearance, don't make me pay, right? The law says we have to let them do that. If they actually do it though, they just blew up my loan. I'm not going to be able to sell that loan. The only way I can sell that loan is by losing tens of thousands of dollars.
I never thought of that.
By selling it scratch and dent. And so it's something that lenders are deathly afraid of now. And it is such a hot button issue. Axia, we chose to add a form to our loan documents that asks the consumer to tell us, do you intend to ask for forbearance after starting this mortgage? If you intend to, don't. I'm not going to give you the mortgage. If you say, no, I don't, I'm going to pay my mortgage as I'm supposed to, great. We want to help.
Yeah, if you're getting paid like normal and you're working, why would you take advantage of that? It doesn't even make sense because they just add it onto the end anyway.
Right. Well, I think, and I don't want to be too mean about this, but there's a certain maybe greed aspect to it. Those people, if you're greedy, you're going to get punished for sure. Those people that are maybe just being really super careful and they're like, let me hold on to as much cash as I can.
Yeah, that's true.
And if my lender says I can skip my payment through a forbearance, maybe I should do that. Here's what I want to kind of caution you though. Those consumers that do a forbearance, the record on their credit and on their mortgage will show that they did not make a mortgage payment. And if you then come to me 6 months later and you're like, I'm ready to buy a house, and I go and look back at your mortgage history and I see you did not make a payment, not going to be able to give you a mortgage.
It affects, yeah. They're not really saying that, so that is a good thing. Somebody also asked, are you going to do an online like first-time buyer class? What a great idea.
Yeah, I could, certainly. I'd love to do that in partnership with a realtor.
Yeah.
Sort of tag team it.
See that?
That'd be great. I mean, all of our loan officers, including myself, would be happy to do a Zoom meeting for your sphere, let's say, to talk about first-time home buyers or to talk about issues and share information. That's good for us. That's good for you. We'd love to participate in that.
So give them your phone number and your email address and all that stuff too.
So I'm John Ingram, 702-324-1683. My email is john.ingram, and it's John with an H, Ingram, INGRAM, at Axia Home Loans with an S.com.
AXIA.
AXIA.
Where's your visual aid?
Oh, but yeah, you guys will see me on Facebook. Friend me. I do videos a lot to kind of share information and try to keep content going out that is focused for realtors and their consumers, to share as much as I can that is timely and that is important as people start making these decisions. There's a lot to know. There's a lot moving around. And I think just being able to communicate and stay in touch with each other is going to be super valuable as we go forward here. Anything else we want to know?
I was told that a loan officer that borrows, I think this is everybody needs 6 months reserves to close a loan today.
That is not true. That is, once again, another lender-specific overlay, as we call it. That lender might have decided that we want you to have 6 months reserves, in order to be able to feel that you are a safe risk. That is their decision. Once again, the underlying rules for mortgages has not changed. It's just lenders deciding where they want their risk.
Okay, cool. All right. Anything in final that you'd like to think that you think they should know, whether be about now or just in general?
Yeah, I think this is maybe some worthwhile info. So let's talk about products in general and what's going on just real quick. So besides the core products, the FHA, the VA, the conventional, all those exist, widely available, money's constantly flowing, great interest rates, that sort of stuff. The alternative loans, non-QM is what we call it, but so bank statement loans, investor cash flow loans, super low credit score loans, that sort of second chance loans, those have pretty much dried up. You may find one, in the country at this point, super hard to get, super rare at this point. That market is fairly dried up. Jumbo loans, so loans that you could prove everything you need to prove, they just want to borrow more than the loan limit would allow. Say $1 million, $1.5 million in a loan. That exists today. We did have Wells Fargo exit that market. They're not into it. They're not buying any of those loans from any other lender. But we still have other investors that are doing those, thankfully, but they continue to tweak those rules. It's getting difficult to do, but it still exists. So you can still service those high-end clients that want to buy a $2 million house and put, $500,000 down. That exists still today. You can still get that money.
Tim Dunn here, one of your favorite people, has asked, he said, I thought that they were granted a forbearance today. It would not affect their credit score.
Great question, Tim. I appreciate that because there's nuance to the words here.
I have the same question.
So yes, and the way the law was written is the lender, upon your request and notifying them that you have been impacted by the COVID-19 crisis, they must allow for a forbearance, right? They must allow you to defer payments. And what the law actually says is, upon your request, up to 6 months. Most lenders, it seems like, are saying, we're going to give you 60 days. Call us back if you need more time. We'll give you more time. And so the first 6 months built into the law. If you ask for it, they must give it to you. There's, in the law as well, if you're still not on your feet at the end of the 6 months, you can ask for another 6 months. Based upon, once again, still being impacted by the COVID crisis. So that's built into it. What's hiding beneath the surface is a couple things. One, they said, we as lenders and mortgage services, we're not allowed to charge you late fees. We're not allowed to charge you interest or extra interest or any kind of penalties. And we're not allowed to report something negative to your credit. Here's the kicker. It's not a matter of just not reporting negative. They're going to put a blank space where the payment should be. The idea is it's going to show, there's going to be a record, you just did not make a payment. That's all. They're not going to report something negative, but they're going to say no payment was made. And that's okay. That's okay for your credit score. But when it comes to me in the mortgage business, for how sophisticated mortgage lending and how many details we look in, we're going to look at, have you paid your payment on time for the last 12 months? Well, 3 months there, you didn't make a payment, so that doesn't count. So you've only got this much time, right? So that is.
So if you go to refinance, you
want to purchase, you need consistent payments, regardless of the fact that you weren't reported late. You did not make a payment, and that's going to be held against you.
So there's the ruling.
So the difference is, one is my credit going to be hurt? No. Is my ability to get a mortgage going to be negatively impacted? Yes. Okay. That's the truth.
For how long would that be?
Depends on the type of mortgage, but it could be as much as 2 years.
All right, awesome. Let's see.
Mr. John.
Yes.
So I got a forbearance agreement with the lender, but it's just standard. It doesn't say how much you need to pay. It just says your loan has been suspended. You can pay partial or you can pay the full amount. Do you recommend that we pay anything? We're so great we just pay partial because we just want to have something.
Right.
What would you recommend? Should we just write it out?
So yeah, here's what you want to know about that. So
repeat what she said, though.
Yeah. So the question is my lender is letting me have a forbearance, and they're saying I can pay a little bit, pay none of it, pay all of it, and they're not talking about anything more beyond that. They're just saying you don't have to, and you can make partial payments. On the question of should you make a partial payment or should you pay anything at all, that comes down to your ability. If it's just a tactic where I can skip this and I like the money being in my bank account more than on the mortgage, you should pay the mortgage. If it's a matter of
agreed,
I need to hold this cash to be able to keep food on my table or to get through this time, then absolutely hold it. What they're allowing for is, once again, built into the law that says they must allow partial payments, and all that's going to do is reduce the amount that you have to catch up when things are over, when you're back on your feet. And that's the second part that is not defined and is not talked about. There's nothing in the law, and this is really important, everybody should know. There was no rule put into the system that says what the lender must do to work this out with you. What you can expect to happen is one of three things. One is they will offer you the chance to pay all the missed amounts in full right at the end of the 90 days or the 6 months. Just write me a big old check and you're caught back up and we'll let you do that. That's one. That one they'll happily do. You won't have to do paperwork. Most likely everything's going to be fine. Option two is they're going to say, based upon you qualifying with me, we're going to make a workout plan that allows you to make this up over a period of time, 6 months, 12 months, where we increase your monthly payment to split up all the dollars you skipped, right? And you'll pay it back piece by piece as we go forward in time. But here's the key. You're going to have to qualify for that. You're going to have to show the lender that you had a hardship, that you are now back ready, or you're back from it. Here you think times are good again, and you can afford to have your payment increased and be okay going forward. The third option is, once again, a qualification approach where they can set aside all the skipped payments and put it on the end of your mortgage. And what they'll very likely do is they'll leave it out there without you making any payments toward it. So you go through all 30 years of your mortgage, you reach the end, well, you still owe this 10 grand of payments you skipped. And now that's due in full, right? So most of those consumers are going to pay that off through a refinance, through selling the property. That money that was set aside is now owed and due in full at that time. It's unlikely that they're going to extend the term of the loan and those kind of things, although there are options. Each lender is going to be empowered to make their own decision in regards to that, and their own decision in regards to your situation. There is not a rule that says they must do any one thing specifically.
Right. So it's going to affect your credit, whether it's a little or a lot, right? So Tim Dunn has another question. He said, do you do the same thing with a car payment?
No. So that's actually one of the, and maybe this is selfish, but all the other things that you can get payment flexibility on, car payments and credit cards and that sort of thing, if it's not negatively reporting to your credit, no harm, no foul from the eyes of the mortgage.
Yeah, because
right?
the mortgage payment has like an X every month that, okay, I can see that. Yeah.
I see an on-time payment was made.
Yeah.
I don't look at your car payment to know that you made a payment for 12 months. I just look to see, was it on time? Are you current? That's all I care about and all the mortgage cares about.
Right.
So yeah, if you can create financial flexibility that keeps you in good stand by delaying the car payment or some other payment other than the mortgage, I recommend that. And I recommend it just in this general picture. Protect the roof that's over your head. Protect where you sleep. That's the most important thing. That is the only thing that is going to build financial wealth for you of all the things you have. Your car is not getting more valuable. Your credit card being paid off is not going to make you more money. Your house does. So protect that above all other things. Besides your health and your family, protect the house.
And my guitars, they get more valuable too.
Okay.
Like, all right, hold on. All right, folks here, thank you very much, John, for coming by today. We really appreciate it. John from Axia Mortgage. See you soon, folks. Thank you.
Thanks.